I will be discussing the benefits and drawbacks of the balance sheet approach, otherwise known as the asset liability approach, to financial statement presentation. The asset liability approach primarily looks at the valuation of assets and liabilities on the balance sheet. This contrasts with the income statement approach, otherwise known as the revenue expense approach, which primarily looks at the recognition and measurement of income on the income statement. In concept statement number 6, they defined the definition of comprehensive income, which they said was a change in a firm's net assets from non-owner sources. So the income statement would basically be a way to record the changes that occurred in a firm's net assets. The asset liability approach aligns with that definition of comprehensive income because the changes in a firm's net assets can be measured by the changes in its valuation of its assets and liabilities, which the asset liability approach is attempting to measure. Additionally, the asset liability approach best aligns with the purpose of financial reporting. Concept statement number 8 defined the role of financial reporting as providing information to help existing and potential investors estimate its value. By providing users with the changes in a firm's net assets over a period, they will have much more worthwhile information to estimate the value of a reporting entity because income will be based off of the real change to assets and liabilities. In addition to more properly meeting the definitions of comprehensive income and the purpose of financial reporting, there are many other benefits to this approach. One of these benefits is that deferred charges and deferred credits can be properly accounted for. Deferred charges and deferred credits are now included in the balance sheet, even though they do not meet the definitions of an asset or liability because of their deferred recognition on the income statement. Since the income statement would be created from changes in a firm's net assets, the deferred items will no longer be on the balance sheet. Some of the drawbacks to this approach are that it is very hard and expensive to measure. When you compare valuing assets and liabilities at their fair value instead of using a simple historical cost measurement, you can imagine the additional cost that's going to be assessed. Finding what the fair value actually is for many assets and liabilities is a very hard task to ask firms to do, also. Another drawback is that management may manage their earnings much more often. When you consider the increased volatility and risk with using fair value measurement, it may cause managers to manage their income much more often. For instance, investment securities are measured at fair value on the balance sheet, and it has been proven in the past that they have either classified their securities or sold securities at opportune times in order to manage their earnings. With an asset liabilities approach, you would expect managers to take actions like this much more often.